Tyson Foods is at its 52-week low, currently offering a yield of 4%. Are we looking at a company that we can be picking up at this cheap price with a very strong yield, with that yield on cost growing to double digits over the next few years? It is down 27% year to date, so let's find out. In today's episode, as always, we're going to look at the historical performance of the company. We want to look at their financial statement, their revenue, their top line, as well as their bottom line net income growth. We want to take a look at the health of this company, their total cash versus their total debt. And we also want to see how they compare to some of their peers in the packaged food and meat industry on a total return basis. We're also going to have a brief look at what the institutions are doing, whether they're buying this company or selling. We'll also touch upon their earnings that they did just release this morning. And we'll also look at some important financial and dividend metrics of Tyson Food. And as always, we will wrap up with our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given that margin of safety. Now, it is down 27% year to date, right there at the 52-week low, and investors who have been holding this company over the last 10 years would be up around 62%. Now, even though that doesn't include those dividends reinvested, it isn't really what we want from our return on investment, and we can see this company did peak at around the beginning of 2022 at around $90. So that's roughly half the share price it is now, so we want to understand, is this one that we can expect to climb up to double or even triple over the next 5 to 10 years, as well as that yield on cost in double digits. So starting off with their income statement, their top line growth, well, revenue in September 2018, $40 billion on the top line. October 22, their latest annual report at $53 billion. So there is some nice positive growth over the last 5 years. On a more granular level, we can also see the increases year on year, some years increasing faster than other years, and we'll shortly look at the last 10 years percentage-wise too. Now, bottom line net income, does it tell a similar story? Well, around $3 billion reported in 2018, $3.2 billion in 2022, so they've increased their bottom line at a slower rate than their top line, and we also see some inconsistencies with that drop in 2018 to 2019 before a small increase and then a larger increase in 21 and then another in 22. So some small inconsistencies on the bottom line versus the top line, but nonetheless their top line is growing. Now, the health of the company, total cash versus total debt, $271 million in cash and short-term investments in 2018, more than double that in their latest report, so they are sitting on around $700 million of cash. Now let's compare that numerically and directionally to their total debt. What we see is around 9.9 billion of total debt, and in their latest report this has come down slightly to 9.3 billion. So not too bad in terms of their debt versus their cash. We do see their total debt in fact decreasing, as well as seeing their total cash increasing. So that is fairly positive. Now, in terms of some of their competitors in the packaged food and meat industry, McCormick, Kellanova, Hormel Foods, and a few others, year to date with those dividends reinvested, aka those total returns, it is one of the worst performing, down 25%. As always, when you have the data available, do try and expand your search to 5 or 10 years. So over the last 5 years, Tyson Foods, again, total return down 9.5%. Again, one of the worst performing in its peers. Remember, as always, especially new viewers, when we look at historical data or past performance, it is never an indicator of the future and is just one good level or layer of analysis to do for any stock. Institutional analysis, well, 64% of institutional ownership, with around 3.66 billion worth of sales of their shares over the last 12 months, and just slightly less at 3.3 billion institutional inflows or buys. So we can see over the main part of the last few years, there hasn't been much difference between the buying and selling at around 300 million. So what we can see, the latest quarter 3 of 2023, around 505 million shares bought with 343 million sold, with the opposite direction in quarter 2. Remember, we also don't copy what institutions do as well. It is part of our own analysis. So September 23, with their latest essential reportings, what we can see is they surprise positive 47%. It was expected by the market 25 cents per share. And what we do see is 37 cents earnings per share, which is positive to see for the market. However, the sad news is that they were expecting 13.72 billion worth of sales, and what essentially was reported was slightly lower at around 300 or 13.35 billion, around 300 and 60 million, 70 million lower, a negative 2.7% surprise, and we see the market right now down 1% for the current share price. So let's take a look and see Tyson Foods, the dividend safety, the metrics, and see whether or not this is a strong performing company. So dividend safety 90, making it very safe. Market cap 16.7 billion. It is a large cap company. And when we take a look at some recession metrics, well, they maintained the dividend over the last recession. They didn't cut it, but they also didn't increase it. Sales were relatively flat, which was above the average growth of companies in the S&P, and it had a near identical recession return to that of the S&P 500 of negative 55. Now, when we take a look at their dividend growth, well, 2.1%, in fact, a dividend increase this month. Not what you want to see. You do want to see 4% or more, as that was the average US inflation rate over the last 40 years. But we see over the last 15 years, double-digit 15% growth year on year. Last 20 years, again, double-digit 13%. So historically, they have paid nice dividend increases. But remember, history is not an indicator of the future. Now, they have been paying increasing dividends for the last 10 years as well, so that is important to note. And dividend yield theory, well, we see our first sign of undervaluation as that current yield sits above the 5-year average. But remember not to look at any of these models in isolation. However, when we look at the forward PE, we can see it sitting at 21, which is much higher than the 5-year average of 12.3. Now, in terms of the sector PE comparison, we do see it slightly higher at 21.1 versus 18.8. And as mentioned at the beginning of the episode, it is at that 52-week low or thereabouts. But remember, 52-week low is never a signal for undervaluation. Now, earnings per share versus free cash flow. Earnings is susceptible to manipulation by management through accounting, so we are focusing on the free cash flow. Below 60% is my personal preference. It does mean, in my opinion, management have the ability, if they want, to offer those double-digit increases. For the large part over the last 10 years, it has in fact been below 60%. However, what we do see in 2022 is 83%, and therefore we do see that very small increase of around 2.1%, which does make sense looking at that payout. Now, in terms of the free cash flow, 215 in 2013, 222 in 2022, which is a shame because before that it was increasing at a nice rate, but we do see that very big drop, which is a bit of a worry and something to just do your own due diligence about to see whether or not this is a company you do want to be investing in for the future. Now, sales growth 3 to 7% is what we like to see. What we do in fact see over the long term is there or thereabouts, and numerically speaking, 34 billion of sales in 2013, 53 in 2022. Now, yes, we love it as investors when companies do share buybacks, returning excess cash to our pockets. And what we see with Tyson Foods, in fact, they have done both share buybacks as well as share issuances. And over the longer part, what we see is that it hasn't really moved over the last 10 years from 367 to 363. Some years we see share issuances and some years share buybacks, but overall around 4 million bought back on a net basis over the last 10 years. Now, ROIC, what we love to see, 10% or more, gives us faith. Remember that management are able to effectively allocate their capital. For the large part, it has been over 10%. There was a year where it did drop below, and over the last few years in the mid-teens, making it very nice to see as investors. Free cash flow margin, operating margin, they do tend to struggle. The consumer staple average is around 16% and 7%, or what we ideally like to see, in fact. And it has been below that on both counts. So it is one just to keep an eye on, especially the operating margin. The lower that margin, the lower that bottom line net income should be. And therefore it does mean those dividends and anything paid out to investors will be lower or higher if it does increase. Now, the important net debt to EBITDA, which does affect that dividend safety, below 4 for the consumer staples is what we look for. And what we can see, this is signaling the number of years it would take the company to pay off all of their debt net of cash on hand. 2021 and 22 around that 1.2 mark, which is very positive to see. Now, it is expected to increase to around 2.5 in 2023. Still below that 4 that we look for, but it is something to keep an eye on as we don't want it to creep up and go higher to that 4 that we saw in 2014. Now, Tyson Foods, what we can do is run it through our stock valuation model. And as always, if you do enjoy the content, value is being provided. Do hit that like button. Do subscribe to be continually notified of these videos as they drop. And don't forget, if you do want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio, do click on that pinned comment below. So let's start off with our first model, Tyson Foods, ticker symbol TSN. The EPS 94 cents, growth rate per analyst estimates, and that current yield on AAA corporate bonds. Now, the intrinsic value is coming to around $44.31, And when we take a look, it isn't far off the current trading price, which does signal around reasonable valuation. But remember, we don't look at any of these models in isolation, and we will conclude towards the end of the episode. Moving on to our second model, we have the multiples valuation model. We have Hormel Foods, McCormick and Kellanova with their stock price, earnings per share and P multiples. We get the average P multiplied by the earnings per share to give a stock price of TSN of $21.78. Now, this was a one-off for Tyson Foods. When we do take a look at their earnings per share, it isn't typically this low, and therefore we have excluded this from our intrinsic value output calculation. But as always, if you do want to include it, we do have the prices, so you can just do it based on your own thesis. Dividend discount model, we have the yearly dividends for Tyson Foods. Now, they did have some very nice dividend growth over the last 5 years. On average, around 10%. Now, forward looking, I have gone for around 4.5%. You could argue higher, you could argue lower. It really just depends on your judgments and estimates. Based on mine at 4.5%, we do get a DDM price of $57. What we can see, that is higher than the current trading price, so it's currently at 46, but below that 52-week high, so showing signs of undervaluation in the current market. We then move on to the fourth and final model, the DCF model, where we have the free cash flows year on year. Average growth around 23, forward-looking analysts estimating around 12 to 14%. Now, with that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to our equity value, divide by the shares outstanding to give a DCF price of $60. Now, again, $60 does show signs of undervaluation in the current market, but it's still below that 52-week high. Now, remember what we are doing for our intrinsic value. It is just the average of these four models, and it is just 3 for today's episode for the reasons we mentioned earlier. But as always, if you do want to include it with your own model, you can just get the price and divide by 4. So we get an intrinsic value of $54. Now, the current price is around $46.77. Now, margin of safety, remember, 10%, wide moat, strong financial metrics, good forward-looking data. It would be a buy up to $48.38. Now, if you are looking for a higher margin of safety, if we start with 15%, it would be a buy around $45.69. We can take a look. It is less than $1 from this price. So you could argue on current price, you're getting around a 15% margin of safety. Those looking at 20%, it would be a buy at around $43. And we can see that is slightly lower than the 52-week low. Now, Wall Street, what they believe, they see the price to go up around $55 over the next 12 months. So they see it in line roughly with that intrinsic value that we have calculated. As always, let me know your thoughts. Is Tyson Foods one you hold or one that you're interested, or if it's one that you sold in the past? As always, if you want to grab a copy of the valuation model, do click on that pinned comment below where you can run your own company through the model, or even if you want to rerun Tyson Foods with your own estimates. Don't forget to hit that like button, subscribe and hit the bell to be continually notified of these videos as they drop on a regular basis. And have a great day. Catch you on the next episode and take care.